Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. U.S. equity markets have been under pressure to the downside here. This morning's drawdown is coming after each of the three major averages logged a third weekly decline in the last 4 trading weeks. So how anatomically similar is today's market drawdown to 1998, for instance? Will it last, or is it just an interruption? Joining us here today to take you through the themes and other things on his radar is Fidelity Director of Global Macro, Jurrien Timmer, joining us from Amsterdam. Welcome. Great to see you, and thank you for joining us.
Yes, good evening from The Hague, from my parents' house where I'm visiting for the Easter holidays. So nice to be with you all.
Oh, we're so pleased that you took this moment out, and we'll try and let you go back to your family as soon as possible. Jurrien, we used to say that one story could dominate the market per day. I feel like that's been played with recently, but there is a story in the market today. Just take us through what we're watching.
Yeah, so the narrow story is obviously tariffs, what that does to profit margins, to inflation, to the economy, how stocks have to be repriced for that. So that's sort of the micro, and the markets are going through that, and we're seeing the earnings numbers get marked down a little bit, not too much. But the bigger story is really, are we starting a new secular regime where the U.S., which has enjoyed a period of exceptionalism for the last 10 plus years, where capital from around the world has come into the U.S. dollar, the U.S. economy, the U.S. stock and bond markets, whether that wave is cresting, maybe not reversing, but maybe not continue to expand. And I think that has meaning for, what kind of risk premiums are investors willing to accept on U.S. bonds and U.S. equities, right? The U.S. stock market has an equity risk premium of 3.9. It was 3.1%. U.S. 10-year Treasury has a term premium now of 70 basis points. A few years ago, that was negative during the era of financial repression. And so I think the question is, if we're entering a period of deglobalization and we're going from a unipolar to a multipolar type of world order, where rather than the U.S. being sort of the benevolent cop who keeps the world safe, maybe at its own expense, to now a period of more self-centered mercantilism, I guess you could call it. That's not the end of the bull market per se, but that might mean that premium that the U.S. has enjoyed over other assets in terms of lower risk premium, a higher dollar, maybe that is now being questioned. And I think that is the overriding theme here. And we see it again today, right? So over the weekend, the administration was criticizing Jay Powell. Certainly nothing new. We had that, during Trump won 5 years ago or whatever it was in the first term. But now with Powell's term actually coming to an end next year, again, the markets are wondering, okay, what does that mean? Who's going to replace him? Will there even be a scenario where, as Treasury Secretary Scott Bessent suggested just a few days ago, where they might install a shadow Fed president who could undermine Jay Powell in his last months in office? And those are the kind of things that were kind of unimaginable maybe some years ago, but that are making sort of global capital wonder, is the dollar still the same place? Is the market still the same place as it was? And how do we play that going forward? So I think those are the really big picture themes that our investors are coming to terms with now.
No, it's great to sort of have you take us through those, because we are watching some of this really play out a little bit. You mentioned the bigger sort of perhaps rotation, but we are, if we look back to history, you'll take us back to history, taking a look at where we are in sort of resistance and then ultimately support. Here we are. Is it week 9 of a correction at this point?
Yeah, so let's go to slide 1. And as strange and unusual as this cycle is, and actually every cycle that I can remember always has been, in some ways this has been a textbook drawdown or markdown, if you will, in the stock market. So what typically happens is, the market goes up more than it goes down. We know that. It does go down 30 to 40% of the time. The odds of a 10% correction are 40%. The odds of a 20% bear market are 20%. And, every couple of years, really in the last 5, we've had major drawdowns, right? We had 2022, that was a 28% decline. We had 2020, of course, COVID, that was a 35% decline. We had 2018, that was a 20% decline. But what you see is the market's always doing price discovery. It's always trying to find the right price to trade at. And where you see that horizontal line there, that was the 10% correction mark. And so 10% corrections happen all the time. It's not a big deal. They don't feel good, but it's not really a big deal. Market bounces off of that, wondering if, the worst case scenario has been priced in. And if it has, the market just bounces off of that, like it did last summer when the S&P fell 10% during that yen carry trade unwinding. And nobody even remembers it because you go on to make new highs and it's, all is well. But sometimes it hasn't discounted all the bad news and there's more news flow, and then you break that that support line, and then you fall further, and typically you go then from 10% to 20%, which is exactly what we did, down to 48.35, and at that point only 19% of stocks were trading above their 200-day moving average. Then inevitably, whatever is causing that storm kind of passes. And in this case, it was the administration under not under Scott Bessent. He's not the president, but he is the adult in the room. I hate to say it, but the administration did walk back from some of the narrative on tariffs, the reciprocal tariffs, because the bond market was having a tantrum. And so that was then the market kind of comes back, it starts to recover, and inevitably it hits a wall at that old support line, which is now resistance. We call that the scene of the crime. And so the market goes back to the scene of the crime.
So that's April 2nd or April 3rd. Yeah.
Yeah. And so then it either stays below, which is what it is doing now, and we continue to find price discovery. And actually, if we go to slide 2, you can see that the 1998 long-term capital management storm, if you will, it did exactly that. And we're pretty much following that scenario, not to suggest that we're going to continue to do so, because history only rhymes, it doesn't repeat. But the point is that, that 20% markdown at the low, that's a significant markdown, right? So that prices in a fair bit of bad news. And if that's all we get, the market can find its footing. And then eventually, if it goes above that line, which is at 5,500, then I'm going to conclude that the storm, whether it's a bear market or a mini bear market or just a sharp correction, that storm has passed and the market can go on and start to recover. If we don't hold that low of 48.35, then chances are this is a real bear market and we're going to go down further, maybe 20 to 30%. And in that case, we go to slide 3, where you can see the history of bear markets and serious corrections. And then it becomes a question of, do you get a recession, right? At that point, if the market takes out the lows of 48.35, meaning it would go down more than 21%, chances are something is amiss, and we're going to have some kind of recession or really a period of significant disruption, whether it's in the dollar or in the bond market or in the equity markets. And again, we're not there yet. We may not get there, so I don't want to project too much. But at that point, you start to figure out, okay, if this is a bear market, the average correction is 33%. If it's a recession bear market, if it's a non-recession bear market, it's 22%, which is what we've already done. And so, we're not there at this point, but the market again is always doing price discovery. The market never sleeps, and that's what it's doing right now. And so the hope is that even with the heavier rhetoric towards trade and tariffs, that it's still sort of the art of the deal, but it's a pretty hard bargain, and that If we start seeing bilateral trade agreements, and Japan and India seem to be at the top of the list right now, if we start seeing that, then I think the markets will breathe a little bit easier, that this is not going to be a blanket trade war with everybody, but it just with maybe China and a few other places, but that it will be somewhat contained. But again, a lot of unknowns still at this point.
That said, you have been saying for months, could the market handle going down or actually staying afloat if the Mag 7 was devaluing? And, from lofty levels, many people thought they were fine. We have seen a devaluation across the Mag 7, and it's been extraordinary. And there's some court cases to throw in there to take a bite out of their valuation as well. There's lots of things going on. Just speak a little bit to either the opportunity or just sort of the astonishing retracement of the valuation story for the Mag 7.
Yeah, it's actually a very positive story. But if we go to slide 16 for a moment, so we've talked, many, many times about the Nifty 50 phenomenon, and then when the market is over concentrated in a handful of very large companies, you run the risk, obviously, that when those stocks go down, the market goes down. And that's exactly, of course, what's happened, right? The Mag 7 has declined 30% in price, and the S&P has declined 20%, but the S&P, like equal weighted, has declined less. And so you have the risk, and again, I make the distinction between the alpha and the beta. So the beta is the market return. So you buy an index fund, the market's going to do what it's going to do. And then the alpha is the relative return that you get from picking the right stocks or sectors or countries or asset classes. And so the risk, I think, is that if the Mag 7, after dominating for 10 years, if that cycle ends, and it doesn't have to be a bubble, and I don't think it is a bubble the way it was in 2000, for instance, but when those stocks become out of favor, and presumably they might go down in that scenario, it's going to be very hard for the market as a whole to rise, or certainly to rise to the degree that it has in recent years. But again, that happens a lot when the valuation extreme is very severe, right? So in the Nifty 50 in the early 70s and the Nifty 50 Part 2 in the late 90s, when those bubbles burst, those stocks were trading at 2 times the valuation of the rest of the market. And at the peak here, just a few months ago, the Mag 7 were trading at 40 times earnings, while the broader market was trading at 25. Yeah. So that's not quite a 2x. But the good news is that today the broad market is down to 19 times earnings, and the Mag 7 have gone from 40 times to 25 times. So 25 versus 19, it's more expensive, as you would expect, because these are big growers. But that's much more reasonable, and it's not that kind of bubble feeling that would lead me to be, much more cautious than I am. And here you can see the earnings estimates for the Mag 7. They're no longer rising, and they're falling a little bit in line with the broader market, but they're still pretty stable. So when you have big free cash flow growers trading at 25 times earnings, which seems reasonable, and their earnings are holding up, that to me is not the recipe for disaster at all. But so that gives me some hope that we're not going to be in a negative beta kind of landscape. But even if we were, it's the alpha that we want, especially when the beta is not as generous as it might have been in the past. And in that sense, slide 6 shows something very interesting, which is that non-US developed markets, so EFI, the MSCI EFI index, the earnings growth rate there is 10% and rising, and the earnings growth rate in the US is 10% and falling. And so that, I think, is really interesting because, as I've said many times on this show, this whole notion of mean reversion between US and non-US is great, and you can point to the valuation difference, right? The US was at the high trading at like 22 times forward earnings. The rest of the world was trading at 14 times. The valuation discrepancy or difference is not enough, but you need a catalyst in the form of earnings, and then you need that amplification from having very crowded positions. And so the fact that the earnings side is now crisscrossing over each other on top of the valuation and on top of the crowding, if you will, in the Mag 7 and sort of the left for dead part of the rest of the world, I think is a very constructive backdrop that I think means or suggests that non-US equities will, that this period of outperformance actually will be one that can last many months, especially if we add to that the fact that the dollar is now, actually we can go to slide 7, is now trading below 100, the DXY or the Dixie as we call it. And so if there is this structural change, and we don't know if it's structural, it could be just a squall. But if that premium valuation, not only in the dollar, but in US equities and US bonds, if that starts to give way to a more normal valuation where the US is just being put on the same pedestal as everything else, then you have a repricing that is going to favor anything that's not in the U.S. As much as I hate to say that. And again, that doesn't mean U.S. assets are going to collapse. I'm just saying they're going to be put on the same playing field as other assets now, and that means that the premium that investors have been willing to pay could get reset to a more normal valuation.
That's so interesting. If we go to the bond market right now, specifically treasuries, you'll hear arguments on both sides, and some will say, well, in the same way that we've seen that transfer perhaps or spreading out of equity, no longer the TINA trade, there's nothing else, or there's no alternative. Is that the same in treasuries? Some people are arguing that, you can go and take a look at European bonds, for instance, and treasuries aren't going to hold the same. I don't know. What do you make of that?
Yeah, I think it applies similarly, and we can pull up slide 9 here. Of course, the U.S. bond market had repriced itself pretty severely in the last, 4 years or so, right? So we went from a 1% yield to a 5% yield, and of course, JGBs in Japan are still much lower, and bunds in Germany are lower. So it's not like the U.S. Treasury market is that expensive, but it was trading, as you can see in the bottom panel, a couple of years ago at a negative term premium. And that's not so much the US relative to other markets, but just that was the weight of financial repression of central banks around the world buying up lots of bonds and suppressing the risk premium there. So the good news is that we're now back at a positive risk premium, which is where, of course, we should be. 71 basis points is the term premium on bonds. And then it's a question of what kind of term premium is appropriate in this era of, obviously fiscal expansion, and possibly a less, hawkish or less independent Fed. We don't know. We don't even know who's going to be the next Fed chair. So that's maybe being premature, but if the term premium is going to go back to 100 or 150, then yields are going to probably be closer to 5 than they are going to be to 4. So treasuries are not necessarily more expensive than other markets. But again, if the dollar loses a little bit more of its position as the dominant reserve currency, and right now 57% of world reserves are in dollars, and that has been coming down over the last 10 or 20 years. So if that continues because the world is sort of deglobalizing and maybe de-dollarizing, right? We buy less stuff from other countries, and therefore less dollars are coming back and buying our treasuries. Then I could see treasuries being closer to 5 than 4 for some time to come. Which doesn't mean that treasuries don't have value. They do. The TIPS break-evens are around 2 to 2.5. So you're getting a positive real yield. But the days of, as soon as there was any kind of problem in the economy, the yield goes to 1%. I don't really see that happening. And that goes for the Fed as well. And if we go to slide 10, actually, I can show you the Fed. It's interesting that as the market prices in a greater risk of a recession, not the dominant risk, not the dominant scenario, but a greater risk than it has been in the past. The market's pricing in a Fed going towards 3%, whereas a few weeks ago it was only 4%. And if we do get a recession, that makes sense, right? Because if the inflation rate's around 2.5 to 3, which is where it is right now, and a normal sort of neutral policy would be inflation plus 100 basis points. A neutral policy would be 4, which is kind of where the Fed is. It's at 4 3/8. So the Fed is holding some of its powder dry because inflation hasn't quite been tamed yet. But the market was correct in saying, okay, Fed goes to 4, that's a neutral policy, that's appropriate for now. And if the risk is a little bit more towards the left tail now than to the right tail, then it makes sense that that curve lowers down, let's say 100 basis points. And so the Fed positioning or the expectations for the Fed, I think, makes sense here, and the bond market makes sense here as well. It's just that you lose that floor of sharply lower rates that we had before,
Right.
and maybe they won't be necessary. And for investors, actually, it's good because you want to earn a real yield that's positive when you are investing in bonds.
Okay. Oh, that's helpful to know. Tell us a little bit on credit spreads themselves. This was something we were watching very carefully, I guess, before. I think the way you said it was the crime scene of the crime, or at beginning of April, and they were fine. They were fine, and then there was actually a bit of a taper tantrum, not a taper tantrum, a tantrum in the bond market. But spreads right now actually are all right.
Yes. So every day, pretty much, when we get these storms, right, and we get them every couple of years, and COVID is still fresh in our minds, even though it was 5 years ago. But that was a cycle where every day you're almost afraid to turn on the computer because you don't know what kind of chaos is waiting. But what I do is I check the boxes of, okay, here are all the indicators I follow, and I follow a lot because I've been doing this for 4 decades. But and you look for signs that are either confirming the price action or are diverging from the price action, either in a good way or a bad way. And so a couple of the things I'm watching, of course, one is credit spread. So that's slide 11. And here the good news is that spreads really have not blown out that much. I mean, if you look at this chart, this shows the high yield spread in the bottom panel on a reverse scale. So down means up, and I do that just to show the correlation with equities. And they did widen significantly from 294 basis points to 503, even though 500 is still the historical average. But as the stock market has recovered, again, back to that scene of the crime, spreads have narrowed by about 60 basis points. And the same is true on the investment grade side. And that's very positive, because if we were to see the stock market do better and spreads do worse, that would be a sign that maybe the recovery in stocks was just short covering and technical and nothing else, even though the fundamentals were getting worse. And so we don't want to see that. So the fact that we see spreads confirming the action in stocks is a good sign. And so this is one sort of green shoot. And again, it could change tomorrow, but these are the things we look for to give us a little bit more of a clue of what's going on. And then the other thing I wanted to point out is on slide 12 is, we look at a lot of sentiment indicators, and we look at the Investors Intelligence Survey, we look at fund flows, we look at other sentiment surveys, and they all show a lot of caution right now, which from a contrarian point of view is generally a good thing. But what investors say is not always what they do, and so that only takes you so far. But then this indicator, which shows what corporate insiders are doing with their own company stock, whether they're selling it or buying it, this is a very reliable indicator that only gives a signal once every so often. And as you can see, most of the time, the black line is above the average, which means that insiders are selling. And of course, insiders are generally selling for a variety of reasons, not because they don't like their company, but because they have compensation that's in stock or that they're liquidating. But rarely does the indicator go into the buying zone. And the old saying is, there are many reasons why insiders might sell, but there's only one reason they would buy, and that's because they think their stock is undervalued. And so we are getting a modest buy signal now. And again, you look at those dates there, the times when those signals are given tend to be around major lows. Sometimes they're early, but it's something I pay attention to. So this and credit spreads are two pretty important indicators that give me some hope that the worst might be over, and that we do some back and forth chop here between that 10% correction threshold, that scene of the crime, and the 20%. And again, if we go back to slide 2 for a moment, I know we're closing in on 12.
No, okay.
The ideal technical scenario, which may very well not happen, but if this continued to be a textbook situation, what would happen is the market would make a new low, a slight new low that would be rejected, and we would reverse, and you would get divergences from breadth, from momentum, from interrelated markets, things like that. And then you get a nice new bull market from there. And that's what happened in October of 1998.
Right.
Now, of course, that was helped by 3 rate cuts from Alan Greenspan, which we are unlikely to get here. But still, that to me, if I'm comparing today's action, and I could wish for a textbook scenario where you get that juicy buy signal that you can really wrap your arms around, that's what it would be. But of course, the market may not make it that easy.
So, I mean, do you think, you don't know, but would Scott Bessent, would the Trump administration be taking a look at that scenario as well?
Well, Bessent is a hedge fund guy, so who knows? But I don't know. It would be nice. I mean, certainly
That's
markets
the bull
can
case.
get markets can get engineered by policymakers, and Robert Rubin, who was the Treasury Secretary under Bill Clinton, he was kind of known for that, right? He would wait for the market or for the dollar or whatever it was to be very oversold, and then he would sort of plant some news on the tape that would get everybody offside. So maybe we'll see.
Okay, so just one thought, sort of looking out to this week ahead. What would you leave investors with?
Keep an eye on the long term. I mean, we're investors, not traders. I assume we're all investors, and we can be liquidity providers or liquidity takers, and we want to be liquidity providers. So we don't want to be on the wrong side of a swoosh event. We want to use them to our advantage and rebalance. So again, if we do end up making a new low and it reverses, and some of these key points that I track are falling into place, then that would be a sign, to rebalance. And if we make a new low and that doesn't happen, then I would say, keep some powder dry and focus on the markets that are working, which is basically everything outside the U.S. right now, or most things. But keep that long view. And again, if secularly speaking, the tide is turning away from the forces that have been in play for the last 10 years. Again, U.S. exceptionalism, dollar hegemony, U.S. assets command a premium because everybody wants to move their money here. If that reverts to something more normal, where it's a level playing field between the U.S. and Europe and Japan and emerging markets, then again, that doesn't mean the U.S. is not a good place to invest, but it's just it would be on the same level. But it would be a regime where you want to focus on the alpha more than the beta, right? When the markets are going up 15, 20% a year, mistakes are more easily forgiven, like if you are in the wrong sector, than if the market's going up 5% per year. Then you really need to pick your spots in terms of the relative positioning more carefully, and then you get into the space of alternatives, and gold is speaking loud and clear. the left behind markets of non-US equities. And, there's a lot of opportunity, a lot of fertile ground. But again, separating the alpha from the beta might be something we will all have to do for the next few years.
I think that's a phrase we're going to be remembering that you've introduced us to first. Jurrien Timmer, a delight to see you. Thank you. We're grateful for your time, and go back to your family celebrating in The Hague. Thank you, Jurrien Timmer.
Yes,
and,
I'm cooking dinner in about 5 minutes.
Fantastic. Oh, fantastic. Okay, great to see you. We'll see you soon. Safe travels.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.